Hello, I hope this finds you well. My name is Anne McCabe. I am one of the managing directors of Curo Private Wealth. And it seems like you can't go anywhere these days without the R word coming up in conversation. Are we in a recession? Are we going into a recession? How long will it last? How bad will it be? There's so many questions. And although most economists on Wall Street have the probability of a recession this year pegged at about 30%, most economists on Wall Street have increased the probability of a recession next year in 2023 to about 40%. So I thought it would be a good time to review some interesting facts about recessions and just sort of clear the noise as we like to do. So first, what is a recession? A commonly accepted definition of recession is two consecutive quarters of a decline in GDP or gross domestic product after a period of growth. But more formally, the National Bureau of Economic Research, or NBER, defines recession in the US as, and I will quote, a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So you'll notice the NBER's definition is a bit more subjective than the commonly accepted definition of the two consecutive quarters. But we want to pay attention to the NBER's definition. It's arguably more important because they are the ones that tell us and determine when we are in recession, and importantly, when we are out of recession and it has officially ended. So the good news about recessions is they don't generally last very long. Looking at the last 10 cycles since 1950, recessions have lasted between 8 months and 18 months, with the average being about 11 months. This is not including the 2020 recession that we had due to the COVID shutdowns, which only lasted 2 months. It was the shortest recession on record. But I wanted to share with you this interesting chart that we have from Capital Group, highlighting that we live in a country with long summers and short winters. While the average recession has lasted about 11 months, the average expansion lasts about 69 months or almost 6 years. Recessions have also been less impactful compared with expansions. So the average recession since 1950 has led to a contraction of less than 2% of GDP, while expansions have grown the economy by an average of about 24%. The last stat I want to draw your attention to on this chart, and this is a very important one, and this may surprise you, so please pay attention, is what the S&P 500 has done on average during expansions and recessions. So you'll see that during the average expansion, the S&P 500 has had positive returns of about 117%. Look at what they've done, or what the S&P has done during average recessions. Returns have been positive about 3% during average recessions. Wait, what? Did I just say positive 3%? Sure did. You heard that and you read that correctly. So this is why it's so critical to not dramatically change our investment portfolios in anticipation of a potential recession that may or may not come, because the market can continue to increase leading up to a recession. So please don't let the financial media freak you out and have you make a detrimental change or decision to your portfolio. So now you have some interesting stats to share with your friends at your next cocktail party about recessions. I'm sure you'll be the life of the party, so enjoy that. Thank you so much for taking the time to watch this. I hope it was helpful. And as always, if you have any questions, please feel free to reach out. Take care.